The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to Property Investing Matters. Thanks for being with us this week for another one of our amazing tax specials. Now remember that our aim is to answer as many of your questions as possible to make the journey of property investing just that little bit smoother, and you can get your questions to me at any time during the week for inclusion on a future show simply by emailing pim@mypropertytv.com.au or by posting it into a comment on any of my Facebook posts. If you've watched before, you'll know that my next guest, Julia Hartman, is a chartered accountant and the founder of Ban Tacs Accountants, which has 13 offices Australia-wide. She's written books on the subject of property and tax and is indeed a guru in the area. Tonight, we're discussing property-related tax and answering the usual raft of questions which always come in when Julia is scheduled to appear. Welcome to the program tonight, Julia.
Hello, Margaret. Thank you for having me.
You're welcome. Look, I want to start out by talking about what's going to happen in terms of property investors and their tax, because I find that what usually happens with most property investors is they don't have a real understanding of what the true after-tax cost of their property is, and they probably don't really understand how to read their tax returns. Now, you sent me along a slide here. Can you take us through this slide now?
Yeah, well, this is what we do after we've done a tax return for an investor. We just look at the schedule, we put the information in and we say, well, as you can see, the tax loss down there is $1,000, so it's a negative geared property, and they're feeling it during the year, all the expenses coming out and wondering whether it's really worth it. So we just sum it up for them by looking at their tax rate. Now, most people's tax rate's around 39 cents in the dollar, so you can see that $1,000 tax loss is going to mean the tax office is going to give them a refund check of $390. So you think, oh, well, it's only cost me $610 to hold the property. Now, these figures are pretty good, really, aren't they? But if you look there, there's building depreciation for $3,000. Now, that hasn't come out of their pocket. So in actual fact, even though it looks like a tax loss on paper, well, it is a tax loss on paper, but it looks like a loss. It's not. That property's actually put $2,390 in their pocket because of the building depreciation.
Yeah, look, I really like this slide, Julia, because it's definitely showing us that people think they've had a loss on the property. And this is almost fodder for all of those share investors who claim that property investing's no good because you lose money every year. But that's a great way of looking at it and showing that that particular property definitely showed a tax loss, but because that $3,000 is depreciable or depreciation and just on paper, then you didn't pay it out at all. And the important thing is, and I want to just go back to this slide again, so let's have another look at it. The important thing to me is when you want to know exactly what your property is going to cost you, you look at what's coming in and look at what's going out. So here, what's coming in is the rent plus the tax return, and what is going out is only the rates and the interest. Obviously, this is simplified and there's more expenses than that. So that's how you look at what's actually coming into your hand every week, every year. And Julia, for a lot of people, particularly in such a low interest rate environment, this amount is more than likely positive these days.
Yes, well, 3% interest rate, yeah.
I think the other thing that people need to understand about it is that the rates of depreciation are going to be different depending on what you buy. For some properties it's more, for some it's less. And depreciation will play a big role in determining just whether you get money in your hand every week or whether you're paying money out every week. However, having said that, it shouldn't really become the basis for how you choose property. You don't choose a property just because it's got big depreciation, because it might otherwise have nothing going for it as a good investment.
Yes, well, the newer the property is, the higher the depreciation you're likely to be able to claim. And odds are the newer the property is, the less central it is. And that's position still applies, doesn't it, when you're looking for a property?
Yeah, absolutely. Julia, a lot of people are building houses at the moment. I'm finding that because sometimes people aren't able to borrow for a whole new property, they might be subdividing and building a second house on an existing property. But there's a lot that they need to know. What are some of the key issues for people who are building?
Well, as far as property investors are concerned, the key issue is you can't claim a tax deduction for your expenses while you're building, and that's all that interest and your rates and insurance and that during that time. So that's rather a killer. You need that to be as short as possible, and while the land's sitting there vacant waiting for the building to start, you can't claim any expenses.
Okay, now that's obviously because the ability to claim expenses depends on the property being available for rent. Is that the reason?
Yes, you have to get it to that stage. So it is very important too that once you do list it for rent that you keep evidence of that, because it might take a little while to actually get the income coming in.
So Julie, all of those costs that you will incur on the way to developing a property, is there no way to claim them, or do they form part of the cost-based to be worked out against capital gain in the future?
Yes, as long as you sell for a capital gain, you can use holding costs to reduce your capital gain, but you can't use the holding costs such as rates and insurance that you haven't claimed as a tax deduction, and interest is included in that. You can't use those to increase a loss. You can only use them to reduce a capital gain.
Right, okay. All right, well, that's good to know. Now, Julia, we've got a lot of questions, and of course all questions answered this week will receive 2 tickets to my 30th of September webinar, and they're valued at $40. So it's a great week to have your question answered. Let's go and have a look at what questions we received this week. And the first one for you, Julia, is a very long one, so bear with me while I read it out. Hi, Margaret and Julia. We are 5 weeks into building a granny flat in Shell Harbour, New South Wales. We have invested several times before, but we are new to building. We started prepping the backyard in May this year, and we've had to pay out of our own pocket, not lent by the bank, $1,500 for a separate water meter, $7,500 for extra piering and a water drainage system, and $4,000 to connect to the existing storm water on the front house. We also plan on landscaping the yard before it's rented out. Are these expenses claimable if we haven't yet rented the property out? We aim to have it rented by November. Is there anything else we can look at in regards to being clever about how and when we get the yard landscaped and paid for? Any other tips for us or traps to look out for? Thank you both for giving up your valuable time, and that's from Rob and Helen. Julia, this is just coincidental that this question is here when we were talking about building houses, because it's a great example of what you were just talking about.
Yes, I won't go into the detail again about not being able to claim those holding costs, but the fact that she hasn't borrowed the money from the bank doesn't change any deductibility. It's a separate thing, the borrowing. So here we have an expense wherever you got the money from, and then we have to look at that expense and see if it's deductible. So most of the things that she's talking there are really going to be Division 43 depreciation, because they're long-term items. They're part of the building. So she's going to have to depreciate them over 40 years, no immediate deduction, and that's depreciation isn't going to start, of course, until it's available for rent. Now, with the landscaping, you don't even get landscaping in building depreciation. You're never going to get a deduction for that. And of course, anything that you're not claiming a deduction for can go into the cost base, and things like the stormwater drain and the landscaping and that will always be in the cost base, they can actually be used to create a loss, unlike the rates and insurance and interest, which can only be used to reduce a capital gain. Did that make sense, Margaret? Did I cover that?
Yes, you did, but I do have a quick question. If Rob and Helen held off on that landscaping until after they had a tenant, and then it was carried out as part of gardening, would that then become a claimable expense?
Only if they lie, because it's an improvement. If the landscaping wasn't there when they started, then it's not a repair. To repair something, it's got to be something there that you're actually fixing up.
Okay. So what about if they have a really bad garden to begin with, just a simple bad garden, but then as a process of over time, the gardener starts to put in a new plant or two, or takes out a dead one and replaces it with a new one, I guess that becomes an expense then.
Well, it would probably slip under the radar, but it's technically not correct. There's a ruling called TR 97/23 that goes into this in great detail. But basically, if the plant wasn't there before, if you're not replacing a plant that died, you're improving it. That's something new you're adding. You're replacing something in its entirety, in theory. So to be deductible, it's got to be a repair. And so it's either got to be fixing something that was already there, that part of it still exists, because a repair can never be a complete replacement, or it can be maintenance, where you're preventing that thing getting worse. But it's what was the state it was in when you first owned it, and if it improves it beyond that state, then it's an improvement. So even if you say it's run down the garden and it's in a bad state when you bought it, well, fixing it up is an improvement. Whereas if it gets run down during the time you own it, then it's a repair.
And it's great to have that clarified so clearly for us. Rob and Helen, one of the things that I guess this teaches you and anyone who's watching the show is that, first of all, before you do begin a build of any kind, it's good to anticipate all of those additional costs. And I find now, if I'm doing a build, and I've done quite a few, I sit down with the builder and say, you need to tell me about everything that's ever happened to you before while building, so I can do a bit of an assessment as to whether that's going to apply to me. I'm building a house at the moment in New South Wales, and exactly that happened. The builder said, no, that's it, but I knew that there was going to be extra, so I made sure I planned for that. And the way I planned for that is I did borrow extra from the bank. Now, while Julia rightly points out that it doesn't matter whether you borrow for it or use your own money, it doesn't change the deductibility of the expense and whether you can deduct it or not. The point I'm making is if you knew ahead of time that you were going to have some things that you didn't expect, you might have been able to borrow more subject to lending criteria and equity available, and then use borrowed funds on those items. You still couldn't have claimed them as an expense, but once it's rented, you then would be able to claim the interest on the loan as a deduction, and you wouldn't be short out of your own pocket. Whenever you're building, you need to plan ahead and ask all of these questions before you begin, so you know exactly where you stand.
Can I just add something to that, Margaret? With the interest on that loan, yeah, it worries me that they'll borrow the extra money to go and do the landscaping, put it in their bank account, and then go off to Bunnings, that sort of stuff. You can't mix it with your own private funds. You're going to have to open a bank account just for that rental property and put it through there for the interest on the borrowings to be tax deductible, which I know you know, but I thought we should say it.
Look, it's a great point, and it also raises another issue, which we always try to point out on the show as well, and that is that if you're using even your credit card for expenses, and if you're, for example, paying off your credit card once a month out of your own account, and you're transferring money into your own account to technically pay you back, you can't do that either. You can't break that nexus between the money and what it's being used for. Make sure the money goes directly from its source to the expense in order for the loan to be deductible. Does that sound about right, Julia?
Yes, very much a heads up. Thank you.
Good for people to know, because people don't know that. Let's go to our next question. This one comes from Trish, and Trish asks, hi Margaret and Julia, I'm wondering if there's any way of transferring property into a self-managed super fund without paying stamp duty. Also, the reverse, transferring property out of self-managed super fund and into personal names without paying stamp duty. We are both retired. So technically she's talking, I guess, about a super fund buying a property off them or them buying a property off a super fund.
Yes, there's no, stamp duty varies from state to state, so it's a bit hard to be an expert Australia-wide, but there's no, nothing that I'm aware of that would ever give that concession. This is the problem we have with buying a property in a super fund that eventually you're going to live in or something like that, because you can't live in it if it's owned by the super fund.
Yeah, look, that kind of transfer is treated just as a straight land transfer, and stamp duty is payable on the full amount of that transfer. And if you give yourself a discount, so say you're transferring out of a super fund into your name or vice versa, and there's any kind of a discount applied, then you still have to pay stamp duty on the full assessed value of that property, not what you paid for it. So there's no way out of that stamp duty, I'm afraid. It's there. The state governments raise a huge amount of revenue from stamp duty, and there is very little that you can do about it. Well, we are off for a break, but while we're gone, you can send those questions that are troubling you straight to me at pim@mypropertytv.com.au, and I'll make sure that at some time we get an answer for you. Meanwhile, we won't be long, so stay tuned and I'll see you soon.
Setting and forgetting your property portfolio can be just as bad as never getting started at all. If you're not staying on top of interest rates, loan structures, tax deductions and current rent returns, there's a good chance that your portfolio is underperforming and you're losing money. Whether you have a large property portfolio or you're just starting out, monitoring your properties is just as important as buying them in the first place. Destiny's Finance and Portfolio Monitoring Service will not only oversee your rentals to ensure they're always achieving the best possible return, it will identify when you're ready to invest again and ensure that you always have the best and most cost-effective loan products available. And with more than 25 years of experience and billions of dollars in finance applications completed, you can be sure you're in safe hands with the experts in the business, Destiny.
Go to destiny.com.au to find out more, or give us a call on 1300 My Destiny.
Thanks for staying with us. You're watching Property Investing Matters. Joining me tonight and answering a raft of tricky tax questions is none other than tax guru Julia Hartman from Ban Tacs. You can join us with your question, and if we answer it, you will receive 2 tickets to my once-a-year national webinar coming up on the 30th of September and well worth a few hours of your time. Let's get back to our discussion tonight. And Julia, I believe that the ATO is no longer happy with just an invoice or a receipt for expenses. What are they looking for now?
Well, it depends on the auditor, doesn't it? But I've had them demand bank statements to show that you spent that money, that it wasn't someone else. And I mean, if you borrow the money off your parents to spend it anyway, it doesn't really matter. It's just, it's almost like a bit of bluff. But if you get caught in this situation with belligerent auditor, I would suggest that you go to ATO complaints. Lovely department. They're great. They sort it out. So there you go. I'm saying something good about the ATO, Margaret, but really don't tolerate it. Go to the ATO complaints department, but better still, do have a separate bank account for the rental property and pay everything through that, and you don't have to face that sort of questioning, do you?
Julia, it could be that some people might be manufacturing dodgy receipts or having their mates give them dodgy receipts for work that hasn't even been completed. And maybe they're looking to see that you've actually spent the money.
Well, the law requires a receipt, an invoice. I mean, there's dodgy people everywhere, isn't there? I mean, you don't...
It certainly is.
You know.
And you know, it's funny because I always find that people think because it's an investment property, it's okay for them to do some dodgy stuff. You know, it's almost like there's that that sense of separation, that it's not your own personal stuff, therefore it's an investment property. Let's milk it for all it's worth. Let's claim everything we can claim and try to get those tax deductions. When it comes to trying to avoid tax, it stuns me with how many people are prepared to really tread the fine line and sometimes step over it in order to get a tax deduction, and yet it's completely illegal.
Well, yeah, I suppose it starts from the point that you think, well, it's my money in the first place, I earned it, and they're not using it wisely enough. So there's that concept that makes them defensive. But generally, I don't find that people want to overstep the line. They want to know every little thing that they can get back because they do resent paying tax. That's a different thing to break the law or lie, you know.
Now, Julia, we often see a situation where property is in one person's name because they might be the bigger income earner, or their partner might not be employed at the present time or at the time of buying that property. So they buy a property in a single name, but the bank requires the loan to be in two names because they need to use all of the income that each person can show. Now, I believe that there's a bit of a tricky situation to be aware of here.
Well, actually, that was my discussion with you, Margaret, was a question for you. I was hoping you could answer for me, because what worries me is a few years down the track and, you know, the marriage is on the rocks and the person who owns the house changes their will to leave the house to someone else, which they can quite legally do. And probably one of the first things you do when you separate is go and change your will. So you've still got both spouses as joint debtors. They're joint and severably liable for the loan. And it would seem to me, if I was a bank, I wouldn't, assuming now that the spouse that did own the property has died, if I was a bank, I wouldn't bother trying to chase an estate if I could get my hands on cash that the other spouse had. And what do they, have you ever seen it in real life, what they do?
Well, what they do in real life is that in the event that there's a divorce and one party is getting the property, then the other party's name is taken off the loan. So it doesn't, the situation doesn't exist. So you're not going to have a married couple who divorce and have a property that one party gets and that other party stays as a debtor on the loan. That's not going to be a situation. So it's resolved a number of ways. Either the property is completely sold and the debt satisfied, or one partner buys the other partner out for however much, and the debt gets satisfied that way, so a new debt is raised. Or if the same debt is going to remain, then the other party's taken off the debt. Then the party retaining the property has to satisfy all the servicing criteria to be able to remain on the debt on their own, but the debt is just transferred over to being in one name.
So the danger time is only really between separation and divorce when the property settlement goes through. So it's not too big.
If you die, then you're probably in a bit of trouble. But in reality, if you died between your separation and your divorce, you're probably unlikely to have rewritten your will to leave your property to someone else at that point. Your will probably still leaves the property to the other party, which most people's will does when they're married.
Do you know what triggered this question was a case, Cowap, where it was the tenants in common. Sorry, not tenants in common, joint tenancy, whereas when Dad died, it should have automatically gone to Mum. And Instead, a 60-year-old child of the couple sued the estate saying, I can't work, I need to be provided from. And normally you'd say, well, it's joint tenancy, it doesn't go to the estate. But no, the judge ruled, yes, this is part of the estate now, I've decided, and yes, the house has to be sold and half of it goes to this son that's not able to work. And that really worried me if there was still debt on the property, but I trust that would be taken into account in the ruling. But yeah, open a whole can of worms to protecting yourself here.
Yeah, definitely a lot of can of worms. And speaking of protecting yourself, I think most property investors aren't well enough protected and don't realise that they really need to continue to review their will every time there's a change to their financial circumstances, which most people don't do. Many people have a will, but for most people it is extremely outdated and doesn't take into account a whole raft of things, like if your children have now grown up, you might have different wishes for your estate than you did when they were younger. If you now own investment properties, you might want to deal with each investment property differently than another one. So you might want to have your will leave X amount to a partner, but you might want certain properties left to certain children. You know, there are a lot of different ways that you need to deal with your wealth once you get a few investment properties under your belt, once your financial circumstances change, once your kids get older, and once you get closer to retirement. And I just am stunned at how few people take at least a biannual look at their wills and make the amendments required. It's not expensive to do, and yet if you don't leave a valid will, or if you leave an outdated will, or if you leave no will, then the consequences for the people left behind can be quite dire. It can take them months, if not years, to get your estate sorted out if your will's just not appropriate for the holdings that you have. So I urge all viewers to make sure that they put in their calendar every second year a date, that they'll have another look at their will, make sure that it's still appropriate, and if not, take steps to make it more so. We have more. Julia, you've got a question?
And consult your accountant regarding the capital gains tax too.
A lot of people don't realise that capital gains tax after death can be quite distressing for the people who receive your assets. So very important. Let's go to our next question. It comes from Philip. And Philip says, hello, I'm planning to sell one of my investment properties, so I'm sprucing it up for sale. If I replace the carpet or any other depreciating items, like for like, is it classified as repairs and maintenance, or does it go to the cost base of the investment property? The IP will realise a capital gain, but I will benefit more if it is repair and maintenance, which I know is irrelevant. Julia.
Right. Okay, well, when we're talking about depreciable items, then that's a whole entirety. So it can't be repairs and maintenance because there's nothing left of the original item for you to be repairing. And it's only a repair that you're going to get an immediate tax deduction for. If you replace it in its entirety, you have to then continue to depreciate it, which is no good because you're going to sell it. So I'd be more, and carpet would be a depreciation item. I'd be looking more for repairs. So, for example, a coat of paint will, providing, you know, you've had it for a few years, it didn't need painting when you bought it, a coat of paint will be fully deductible. But there's a trap here in that you've got to incur the repair expense in a year the property earns rent. So you're right now, if this is about to happen, but say your tenants move out in June, you're going to have trouble getting all these expenses incurred in a year that the property earned rent. Once the 30th of June ticks over, you've lost any chance of a deduction anyway. But all of these things will be relevant for capital gains tax, though with plant and equipment, it's a bit messy, but it's not your worry, it's your accountant's worry. The main thing is that you need to look for things that are not plant and equipment if you want an immediate tax deduction.
Yeah, good advice there. And you know, Philip, your question raised another question that I think a lot of property investors really need to think about, and that is that if you buy a property that has been just renovated, so say the prior person carried out a whole pile of renovations like Philip is talking about, new carpets and new blinds, and maybe they did some stuff to the kitchen and the bathroom, even if it's not been lived in or not being used at all, and those items are technically new when you buy them, you don't get the deduction on them or the depreciation on them because you didn't acquire them, you didn't pay for them or put them in the property, and therefore the person who is selling it is the only person who could have claimed any kind of deduction or depreciation deductions on those items. So very, very important change to depreciation that was made a couple of years ago. That's made a big difference to how you buy property. You're almost better to find a property that needs that renovation and do it yourself. Pay less for the property and do it yourself. Let's go to our next question from Sharon. Nice quick one. And Sharon says, hi there, my properties are under a family trust. Can I pay my children? Julia, I guess really whether there are properties in the family trust or shares or it doesn't matter what, the question's really about the income to the children, not about properties at all. That's my take on it.
Yeah, I guess she's referring to properties in the fact that it's not personal services income or something that you can't distribute to your children. So it's passive income, it's investment income, and these properties obviously aren't negatively geared because there's profits to distribute. And when she says family trust, I hope she's referring to a discretionary trust. If it's a unit trust, you can only distribute profit to the unit holders. So I'll put that aside. Assume it's a discretionary trust because that normally would be the case. A discretionary trust you buy property in, so you've got a bit of asset protection. So yes, she can pay her children technically, as long as they're within the trust deed, they could be considered beneficiaries. But she's got to consider that if they're under 18, they're going to only be allowed $416 as their tax-free threshold. A dollar over that, and it gets taxed at 66 cents in the dollar. And the worry here is if you've got a discretionary trust and you put in new carpet as a deduction, and the tax office comes along and audits you later and says, no, that's plant and equipment, you've got to depreciate it, so we're upping the profit. They pro-rata at that. So you might have said in your distribution statement that children are only going to get $416 each, and there's 3 children, and let's say at $416 each, and that added up to the total profit. Then the tax office denies the carpet expense, and that's $900. So now each child will be given taxable income of $7,016. You can't change it later. And so that extra $300 or the extra $900, because they're all children, will be taxed at 66 cents in the dollar. Now, did that make sense, Margaret? Would you like to clarify that?
Yeah, it kind of did to me, but then I know what you're talking about. I think the bottom line is that people use family trust thinking that they'll be able to make distributions to other people for income that they receive into that trust, whether it be income from or passive income from a property or a share, or whether it be income from maybe a trade if you're a plumber. I mean, many years ago, tradies set up these family trusts because money could be paid into it, and then they could throw out money to their spouse who did nothing and basically halve their tax by not having it all come to them. So the rules changed, and the bottom line is just that any income that goes out to someone in a trust, if it's earned income, they have to show that they earned it, so that it can't be unearned income. Any money that goes out to children, because if they're under 16, we'll get the children's tax of basically 66% on almost all of it, except that $416. And so therefore it really makes distributing out to children not worthwhile. If you think about it as well, if the kids then get over 16 or over 18, if they have a job, then anything you give to them gets tacked onto the top of their other income and taxed at their highest marginal rate of tax. So those sort of tax benefits or loopholes of family trusts aren't quite as good as they used to be. Having properties in a family trust in the early days, when there's a lot of good deductions and it's negatively geared, loses some of its appeal because it's better in your own name. I think you need to think very clearly before you put properties into a family trust, because the benefits that you might think are there might not be there at all. and it might be just an extra expense at having the extra tax return and everything you need to do with the trust, and you might not get the benefits you were hoping for from it. We've got another question before our next break, and this one comes from Chris, and Chris says, "Hi Margaret and Julia, I'm interested in building a granny flat on my property in addition to the existing 3x1 freestanding house. How much and what exact components of the granny flat are tax deductible as an expense? I've heard or read the approximate cost of a granny flat is around $100,000. Is it as straightforward as a flat $100,000 expense, or is it something along the lines of it being a capital works deduction rather than a renovation expense?" Julia, I wouldn't imagine that anything in building, any building on your property, regardless if it's a granny flat or whatever, would be an expense anyway, except for maybe a few small items.
No, this is the same as building a house afresh on another block of land. You're looking for mainly your Division 43 depreciation over 40 years for the building. There'll be plant and equipment there like your hot water system, your stove, your carpet, that sort of stuff that'll be depreciated a bit more rapidly. The only thing that is part of the original home is the piece of land, and you may get some interest deduction for the borrowing for that piece of land after doing some apportionment. But the $100,000 that they're talking about here, no, it's all going to be depreciation at various rates. And if you can get the builder to break it down into, now if you go to the ATO rental property guide, right at the back of that, it's got a breakdown as to what is plant and equipment and what is building, and how quickly you can depreciate. If you can get the builder to break down your expenses, then you've got what you need to claim depreciation over the years that it's a rental property. And don't forget this also, if it's all on the one title, creates all sorts of problems for capital gains tax. If it is your home that's at the front, and I'm sure Margaret would have something to say about how she thinks that affects the value of the home too in that case.
Yeah, absolutely. And what Julia is referring to is that there are areas where granny flats are quite acceptable and may indeed improve the value of your property. And there are areas where they may detract from the value because people don't want to buy a property that has a granny flat in the backyard. You need to be very sure that the area that you own the 3x1 in is an area that also lends itself to that granny flat. A lot of people prefer to have the backyard. So essentially what you're doing is you're reducing the pool of potential future buyers, reducing the demand, and therefore reducing the value. I normally find that while $100,000 will build you a granny flat, I think you really need to plan on 120 to 130, to be honest. By the time you've done everything else that needs to be done, I think 100,000 wouldn't get you much of a granny flat completely finished and ready to go. So let's say 130,000. It would be unusual for it to add $130,000 to your value. More likely maybe 50 or 60,000 to the value, but I don't often see them add the cost of them to the value of the property that you already own. Lots for you to consider there, Chris. Stay tuned while we head off for a quick break. Enjoy the messages for the next 2 minutes, and I will see you back here very soon.
Nightclub king, girl, mama got shake for that and it's all sweet, girl. Looky here, lady, gotta know what I mean, cause I burst the swagger like a pimp when I flip through the room like boom. Tell me what you gon' do. Okay, girl, I did this for you.
you for once again tuning into Property Investing Matters. I'm Margaret Lomas from Destiny, and we've been getting through some tricky tax questions with Julia Hartman from Ban Tacs. There is still some time to email your question to me at pam@mypropertytv.com.au, and if we don't get to it tonight, we'll carry it over and answer it on another show, and you will still win 2 tickets to my September 30 webinar, which is worthwhile getting those tickets to. They're valued at $40. I generally release my list of areas to watch, and we'll be talking very much about the post-COVID property market and what you can expect to be happening for your investment properties. Julia, there's one more situation I'd like to bring up. It's probably one that's not overly common, but we're often talking on this show about situations that nobody else talks about because they're not common enough. Now, what about if you're an executor of an estate? You're a resident of Australia, but the estate or the estate is part of a non-residence estate. There's a bit of a catch there, isn't there?
Yes. Scary stuff, actually. So what happens is if the executor is a resident of Australia, then the estate is a resident of Australia for tax purposes. So instantly the person dies, all the person's assets become assets that are subject to tax in Australia. Now, it's not too scary on the basis that at least when they get the changeover, you get everything reset to market value. But there are some messy businesses because you'll get no main residence exemption. So you know how you have 2 years to sell the deceased's home without capital gains tax applying? You don't get that because the deceased is a non-resident. It's something that people don't realise, that they've got to stand back and say, I better get advice on this. It's not that straightforward. And like, for example, in the UK, there's a death tax of about 40%. Well, you don't get tax offset for having paid 40% death tax in the UK. That's not an expense as far as Australia doesn't recognise it. So you come back to Australia and they go, righto, we're going to touch up the capital gains tax here on this and that. And you've got to pay that tax in Australia and you don't get any credit for what's being paid overseas. But the saving grace is you're only going to you get that market value reset at date of death. So as long as the estate doesn't go on too long, there shouldn't be too much tax involved.
But often they do, that's the thing. I've seen estates that have gone on for years before they're actually decided, before they, they sit intestate for a long, long time. So I guess the moral of the story is that if you are a non-resident and you have, a significant amount of assets, be careful if you're choosing an executor who is a resident of Australia, then whatever that executor's status is tax status is essentially what applies to you. That's what you're saying, aren't you, Julia?
Yes, and even we've got one at the moment where there's 2 executors and they both live in 2 different countries different to the deceased. It's just a nightmare.
So in Australia, it's the tax status of your executor that rules, not the tax status of you when you die, which means that if you are presently a non-resident living here in Australia or living anywhere and you've chosen an Australian resident for your executor, just be aware that this could be an issue and it might not be the best way to go. Now, Julia, we still have a couple of questions left, so let's go and see what those questions are. And the first one comes from Ben. And Ben says, "Hi Margaret and Julia. I have a question about capital gains tax and non-residents. My parents have their family house in Sydney, which is owner-occupied. They do not have other houses in Australia. They normally spend 6 months a year travelling overseas. Recently, they've been overseas for 11 months and are unable to come back to Australia. They're staying at the relative's house overseas at the moment. They wonder whether they need to pay capital gains tax for the family house or the inheritors if they pass away while overseas. The utility bills, bank statements and mail are still all under their names and are directed to the family house in Sydney. The younger family members are still living at home. My parents are still lodging their tax returns. They're not sure whether they'll be deemed to be non-residents if they pass away while overseas, as they're in their late 70s and have been away for a while. Julia, this is just another example of how COVID really has had a big impact, and I wonder whether there's going to be, some exceptions made, given the situation being a pandemic that we've never seen before.
Yeah, no, they are pretty safe because fortunately for them, they're not going to take up a job overseas and that, but I can see that being very bad for young people that might set themselves up, send their kids to school overseas. They're stuck there, that sort of stuff. So it's all a question, as you can see, of residency, whether they're a resident of Australia for tax purposes or the country they're living in. Now, not every country, because some of them we don't even have double tax agreements with, but we have different double tax agreements with different countries to decide who gets to tax what and when you become a resident of that country as opposed to Australia. And there's little tiebreakers in there, and they do differ a bit, and I don't even know which country this one applies to, so I'm just going to say that there's a pretty good consistent approach that's wide enough to cover this circumstance, but that they haven't set up a home overseas, they're not working overseas, don't join any clubs, don't become too settled there. Living with relatives is a good one. I like that. And because they're still maintaining their home in Australia, they've still got bank accounts in Australia, they're still lodging tax returns in Australia, make sure you continue to tick the box that you're a resident in Australia. They should be right for a long time, simply because they're not really forming too strong an association with the country they're in. It worries me for younger people that might take up a job, become more settled, and then they're caught by this horrible law that says if you sell your home while you're overseas, doesn't matter how long it's covered by your main residence exemption, lose it completely. And she's quite right. If her parents were to die overseas, then they could, but there's a carve out there for people that have only been overseas for 6 years and die. They don't get caught on that problem either. So all in all, she doesn't have anything to worry about, but I'm very grateful. He Ben doesn't have anything to worry about, but I'm very grateful that he sent in the question, because it is something that everyone needs to think about and consider the pros and cons before they do anything and get advice.
Yes. People just don't realise too. They take off overseas, leave some assets here, and you don't realise that there can be a big impact. And anything that you do, the moment you begin to own assets, mostly property, then before you make any move to do anything, just pick up the phone and call your accountant and ask them what the impact is going to be on you if you do these things. And make sure you have a good accountant, because they can't all answer these questions as well as Julia can. Let's go to our next question. This one comes from Jeanette. And Jeanette says, "Hi, Margaret. We are looking at lending a deposit for our daughter to buy an investment property. What do we need to be aware of?" So Julia, assuming that Jeanette means that they're going to lend the money to their daughter to form a deposit for her to buy a property. Are there any tax consequences there?
No, they should be pretty right as long as the daughter doesn't pay interest, but just don't let the bank push you to put your name on the deed of your daughter's house. Don't let them play this, we're looking after your interests and all this sort of stuff. That's when the problems start. That's where there's no capital gains tax main residence exemption for your share of the house. So just get the money that you need against your house or out of your savings and give it to your daughter. Now, you might want to enter into a loan agreement in the event of possibly, if your daughter's married, a marriage breakdown, so you can claw that back, but don't charge any interest and you won't have a tax consequence. If the bank does force you to go on the deed, then you can enter into a contract at that time to agree to sell the house to your daughter in 5 years' time, at which stage the bank may let you come off the deed because she's got more equity. And then, as you know, capital gains tax deemed to be sold when you enter into an agreement to sell. That's when the event happens, and it's at market value at that date. So even though you sell in 5 years' time, you're not going to get taxed on the capital gain in that interim 5-year period, because you entered into the contract at the time you bought the house with your daughter, and the market value then is the price you paid for it. So no capital gain.
Excellent. That sounds like a good plan. The one thing I'll add, Jeanette, is from the bank's perspective, if the amount that you're lending to your daughter gives her less than a 20% deposit, then you might struggle a little bit for your daughter to get the loan without you being at least a guarantor on that loan, because it isn't considered genuine savings. It's a very interesting little anomaly that if somebody has 20% or more, then they don't care where it came from. But if it's less than 20%, they want to see that your daughter saved it herself. And if it is a gift from parents, that's okay, but often they'll want the parents to be a guarantor on that loan as well, since they gave the money as the gift and the daughter hasn't demonstrated the capacity to save. So just be aware of those things when you're going to borrow, and make sure that you have someone who can give you good advice on that. Next question is from John. John says, hi, what are the advantages of buying a property in a trust or company structure, and when should you consider those types of structures? You know me, Julia, I don't like anyone buying in a trust or a company.
Over to me now, is it?
Yes.
Yeah, that's it. Okay. I don't like companies because they don't get the 50% capital gains tax discount. So that's out from me. I don't mind trusts, but you can't negative gear through a trust. So the normal reason, you were saying earlier, Margaret, that you can't depreciate anything against shares. That's why shares can't be negatively geared, that sort of stuff. So there's a good chance that if you're going into property, you're going in there for the negative gear, or at least for the fact that you can claim some building depreciation to get your tax down. And if that creates a loss, that loss is stuck in that trust until you can bring it up to a profitable property, and then you get to soak up those losses. Or if you're in business and you've got another trust, that trust can distribute to your trust. But by general rule of thumb, if you're looking in the negative gearing area, then you probably won't want a trust because it won't stack up as well in the numbers. And the simple thing is, before you buy, you do the numbers with your accountant. Now, the trust does get the discount. The 50% discount flows through to you. So, and it does give you a bit of flexibility. You might want, I've had, one of the times I think a trust is very useful is when a person's young. So when it's negatively geared, they're on very low income and the negative gear isn't that valuable to them. And sure as eggs, by the time they get on a high income, it's positively geared and it's costing them a lot in tax. So maybe it's nice to quarantine the losses in the trust until it becomes positive, and maybe by the time it becomes positive, they might have acquired a spouse that they want to distribute income to, or the kids might have turned 18. So it is very much horses for courses, and a trust is worth considering also because it does give you some asset protection. If it's discretionary, then if you do something that makes you get sued, they can't generally touch the assets in a discretionary trust, and it does allow you later on to decide when you acquire spouses, your children reach 18, to distribute profits to them.
Well, there you go. Very complicated. And I think if your plan is to buy in a family trust, be aware that in the short term, when the property probably has the biggest amount of money on it and the lowest amount of rent that it will ever get, because it's assumed that rent will go up over time, that's when the property will have that on-paper loss. And if you have it in your own name, then it can get you some good tax deductions to help manage that loss. I think that the important thing is that when you first own a property, it's good if it can pay for itself, and it will be able to do so if it's in your own name, in most cases, depending on how much you're borrowing and how much rent it's getting. But if it's in a trust, then you don't get the benefit of that. Those losses are quarantined, they don't come to you at all. So that's a bit of a problem as far as I can see, and for most people, a trust, unless you've got a real reason for it, is not necessarily the best way for you to start your property investing journey. Well, that is a wrap for this week's instalment of Property Investing Matters, but we're coming back again next week, and in fact most weeks you can catch me and an expert guest talking about all things property. If you missed past episodes, they do stay on the website for a month, after which a free sign up to destinylive.com.au will get you not only every past episode, but plenty of other great educational videos that I've put together over the years. For those of you who heard your question being answered by either me or Julia, send an email to pim@mypropertytv.com.au with the subject ticket prize. Tell me your name and which question you asked, and your tickets for my webinar will be sent straight to you. If you didn't win, you can get hold of those tickets via my website, destiny.com.au. It's always a great night with tons of valid information included, including a vital market wrap, which considers the pandemic, and my annual list of areas to watch. Thanks to Julia for being here tonight, Julia. Always great to have you on board.
Thank you for having me, Margaret. Good night.
And if you can find Julia at bantacs.com.au. Now, there's also an abundance of helpful material on their property investors page. And Julia herself will answer questions in the Ask Ban Tacs section. So it's a great resource. Make sure you put it into your favourites and go to Ban Tacs anytime you need any good tax information. Don't forget to give us a call to ask about Destiny Property Match, which is a great new way for you to get all the support you need to buy a property which is just right for you without the expensive price tag of some buyer's agents. Just drop me a line if you'd like to know more. You can catch me on all of the usual places. You just saw them there, Facebook, Instagram, Twitter, my website, name it, and you can get an email to me via pam@mypropertytv.com.au. Have a great week, and I'll see you back here next week.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Are you a do-it-yourself investor who likes to have control over your own financial circumstances? You may not know this, but it's a fact that most failed property investments happen because the investor didn't have the skills or knowledge to pick a good property. Don't let this happen to you. By undertaking our comprehensive, online and fully interactive property investor education course, you'll get all the knowledge that you need without leaving home. There's simply no other course which offers so much, and you'll emerge a fully fledged and confident investor, ready to tackle head-on your next investment property purchase. Don't join the thousands of property investors with dud properties. Get educated now and take your financial future into your own hands. Destiny, empowering you to buy the right investment property.
Go to destiny.com.au to find out more, or give us a call on 1300 My Destiny.
We can fly.